Welcome back to Griffonomics, where we conduct financial investigations to define the risk before we look at the reward. And today we're diving into the discipline of selling. And, this is arguably the most psychologically difficult part of investing.
Oh, absolutely. Buying is easy. It's all hope and optimism.
Exactly. But selling forces you to fight your own instincts, to let go of something that might even feel like a winner. And that leads to the biggest mistake we see.
Cutting the flowers and watering the weeds.
Right. And that phrase perfectly captures the problem we need to solve for you today.
It does. A disciplined selling strategy is, well, it's absolutely required to maintain portfolio quality by avoiding that psychological trap of watering the weeds.
Mandating an exit only when the thesis is broken, a better opportunity exists, or the expected return falls below the historical benchmark.
That is the entire game right there.
Yeah.
But, to understand when to sell, you first have to be ruthless about why you bought. And that all starts with quality selection.
Okay, so let's unpack that, because this is the foundation, right? The non-negotiable part. Our sources are clear. Long-term wealth comes from owning companies with two key traits.
That's it.
First, they need a wide moat, a durable competitive advantage, and second, a history of consistent dividend growth. Without those two, you're just speculating.
And that wide moat, it's everything. It's the structural barrier that protects a company's profits from competitors.
Because profit always attracts competition.
Always, until the profit is gone. So we look for four main types of moats. The first is pretty simple. Cost advantages.
Just being bigger and cheaper than everyone else.
Exactly. Economies of scale. Think of a huge retailer whose buying power lets them crush any local competitor on price. Second, network effects.
Where the service gets more valuable the more people use it.
Right, like a payment network. It's only useful if everyone you know is also on it.
And the other two are less about scale and more about, making it painful to leave.
That's a perfect way to put it. Third is switching costs. This is a huge one for, say, enterprise software.
Oh, yeah.
If a company has spent millions integrating a system, they are not going to rip it out. They're locked in. And finally, you have IP and brand power.
So a unique patent or just a brand that people will pay anything for?
It gives them real pricing power. Think luxury goods or a critical drug.
Okay, and that brings us to the second trait, consistent dividend growth. The sources call this the truth serum for corporate health, which I love.
It's such a great phrase because it tells you two things. One, management is confident they can keep paying you, even in a downturn.
And two, it keeps them disciplined.
It forces discipline. You're less likely to go on a reckless spending spree on some terrible acquisition if you know you have to write that dividend check every single quarter.
And in this new world of higher inflation, that growing income stream is probably the best natural hedge you have.
It preserves your real purchasing power.
So let's add a layer of nuance here, especially for real assets. The idea of asset fungibility. It sounds technical, but it's critical.
It's an absolutely essential and often missed part of risk management. Fungibility is just how easily can a physical building be repurposed if your tenant goes bust?
And you want high fungibility.
You want high fungibility safety. The classic example is what the sources call a generic box.
Like a standard warehouse or a simple retail space.
Exactly. Something leads to a Walmart or a grocery store. If that tenant leaves, well, you can lease that box to almost anyone else with minimal cost. The building itself holds its value.
So your risk is mostly with the tenant's credit, not the building itself.
Precisely. Now, the opposite is low fungibility risk. Think of an asset custom built for one specific purpose.
Like a Topgolf facility. Or one of those specialized oil change places.
Perfect examples. Or a custom data center. If that tenant defaults, that building is an albatross. It's incredibly expensive and difficult to release. It becomes dead money.
You have to evaluate the tenant and the box they live in.
The less flexible the box, the higher your ultimate risk.
Right. So once we've selected these quality companies, the next puzzle is portfolio construction. How do we put them all together?
And this is where we balance the statistical ideal of diversification with the practical reality of being human.
The statistical ideal is that Galton Board thought experiment, right? Where thousands of random events smooth out into a perfect, predictable curve.
Yes, which suggests you should own hundreds of companies to smooth out all the chaos. But we aren't robots.
And that's the limit. Cognitive bandwidth.
Exactly. The real limit on diversification is how many companies you can actually understand and track. Read the filings, listen to the calls, watch management. If you own too many, you're just a closet index fund.
So to manage this, the sources suggest an investment pyramid structure.
Right. It's a way to balance income and growth at the wide base, the bedrock bastion. That's your foundation.
High yield, lower volatility stuff.
Yep. High-yield REITs, BDCs, business development companies, they act like private lenders and provide that stable, high-yield income.
And then at the top of the pyramid.
That's the growth citadel. This is where you put your lower yield but higher growth potential assets. Think defense contractors, certain tech names. This is for capital compounding.
Okay, so the pyramid defines the role of the asset. But how much you put in each? That's decided by conviction. Confidence-adjusted return.
Yes. You're not just looking for the highest expected return. You're plotting that return against your own subjective confidence level that it will actually happen.
And when those two things line up perfectly?
You get the jackpot, the no-brainer idea. That's high confidence, 90% plus, and a high expected return. That's where you get aggressive with your weighting.
Wait a second. The sources say that in extreme cases, a no-brainer could be up to 40% of a portfolio. That sounds like betting the farm. It goes against all the traditional advice.
It does, and that is the single most important caveat here. This strategy is not for everyone.
Because if you're wrong about your confidence, it's catastrophic. That kind of concentration only works if you have been ruthlessly honest in calibrating your circle of competence. If you truly know a sector better than 99% of the market, then concentration is rational. If not, it's reckless.
It's a self-awareness contest, not an IQ contest.
That's it, exactly. You have to know the edges of your own knowledge.
Which brings us right back to selling. The whole point is portfolio maintenance, right? Moving capital from good ideas to great ones, dictated by fundamentals, not price.
We have to be surgeons here, ruthlessly cutting what no longer serves the whole. And there are really only 3 valid reasons to sell.
Okay, what's number 1?
Reason 1, the thesis is broken. This is the big one. It's non-negotiable. The fundamental reason you bought the stock is gone.
So management fails to deliver on a new product, or a competitor just eats their lunch and erodes the moat.
Exactly. The reason for ownership no longer exists. You exit, you take the loss or the gain, and you move on.
Okay. And the second reason is more about underperformance than outright failure. Right. Reason 2, deteriorating returns. Every dollar in your portfolio needs to clear a certain hurdle. If the expected future return drops below, say, the historical 8% market average, that capital is better off somewhere else.
And you spot this by looking for things like margin compression or rising debt.
Key indicators. Margin compression means they're losing pricing power. Stagnant revenue, rising debt. The stock might not be crashing, but it's become dead money.
And the last one is the toughest, emotionally, especially if the stock is still doing okay.
This is the ultimate test of discipline. Reason 3, opportunity cost. This is when you sell a perfectly fine company. Maybe it's giving you a reliable 6% return.
Not because it's broken, but because you found something much, much better.
Precisely. You've identified a high conviction, maybe 15% returner. You're not just selling, you're executing a strategic upgrade of your capital from a good position to a great one.
Okay, so now we know when to sell. What about the traps? When should we absolutely not sell?
The enemy of compounding is panic. Simple as that. You have to resist selling during short-term volatility. The perfect case study is Apple in 2018.
The stock fell off a cliff, right? Dropped almost 40% on fears about China.
And anyone who panicked and sold there locked in massive losses. But if you look at the fundamentals, the thesis was intact. The ecosystem, the brand, the services revenue, nothing had changed.
And the stock then tripled over the next 5 years.
Volatility is just noise. It's not a fundamental change. The other big trap is herd mentality.
March 2020.
March 2020. Everyone was screaming to sell, and if you sold then, you sold at the absolute bottom. You have to think for yourself when the market is at its most emotional.
It all comes back to that metaphor we started with. Selling your winners and holding your losers is like cutting the flowers and watering the weeds.
You starve your best ideas and let your worst ones drag everything down.
So zooming out, how does this all fit into the current macro picture? Because things have changed.
A huge paradigm shift has happened. The post-2008 world of zero interest rates is over. It's done. We are in a higher for longer environment now.
So for you, the investor, that means you have to shift your focus.
You have to. You need to focus on real assets and value. Companies with tangible assets and real pricing power that can handle inflation.
Which makes that dividend growth even more important.
And a fascinating way to apply this right now is with the picks and shovels of the AI boom.
Don't bet on the software, bet on what the software needs to run.
Exactly. Don't speculate. Invest in the bottlenecks, the land and the energy infrastructure that have to exist for data centers to function.
And this brings us back to moats.
It does. A specific example is investing in Permian Basin assets. Because of a regional oversupply, you can get access to what is essentially basically free natural gas.
Which is exactly what data centers need for cheap, reliable power.
It's the ultimate durable moat. You own a critical, irreplaceable piece of the AI infrastructure supply chain.
So this all shows that disciplined investing, it's a constant process. It's not just what you buy, but what you are willing to ruthlessly cut to keep the portfolio healthy. Which leaves us with a final provocative thought for you to consider. Are you truly calibrated? Meaning, have you really assessed the edges of your own knowledge well enough to justify the level of concentration you have in your portfolio right now? Risk defined, portfolio protected.